I do expect interest rates to go up, but I expect them to go up less than most people expect them to go up. So I expect bonds to perform modestly. Uh, with equities, we're at a Dow Jones of 18,000, but when you look at that diagram that I began with about how much stocks go up over the past 200 years, we still want to be in stocks. Even at 18,000, we want some of our money in stocks. The U.S. stock market has performed especially well, and I'm really bullish on the U.S. stock market. I think we have an incredibly creative economy in this country, and I think it's going to continue to do well. But with the U.S. stock market so high relative to international markets, even though I'm very bullish about the U.S. economy, I think that that is more than priced into the stock market valuation levels we see. So I believe that having a good international exposure is important at this time for the purposes of diversification. I don't expect the global economy to outperform the U.S. economy, but even if they performed equally, you're going to be better off in the international stocks because they are more attractively valued than are the U.S. stocks. So one last point on this international versus domestic stocks. The typical American puts little or modest amounts of money in international stocks, and the typical person who lives in another country, such as France or Germany or England or Japan, puts a relatively modest amount of money in the U.S. compared to what they put in to non-U.S. countries. That's called the home country bias, and I think it's dangerous. If we were to ignore the home country bias and forget that we're Americans for a few minutes, we would, to be perfectly diversified, we'd probably only have 35% of our money in U.S. stocks, and we'd have 65% in non-U.S. stocks. That's really the appropriate balance if we're not U.S.-centric. Now, I understand being U.S.-centric. I think it's appropriate to be U.S.-centric. But should we really be putting 80 to 100% of our money into U.S. stocks and only 0 to 20% in international stocks, especially emerging markets? And my answer to that is no. I believe that we want to move towards more of a rational level of diversification between those two alternatives. And I even would think it's reasonable for investors to put as little as 40 to 60% of their money into U.S. stocks and to put the other 40 to 60% into international stocks. I'm talking about the percentage of your money that you have in stocks, not the percentage of the whole portfolio. I think that's a bit too aggressive for some investors, and but I certainly believe in this international diversification and not being so U.S.-centric that you keep 90 to 100% of your money in U.S. stocks.